She was going to be on.
Okay. Does she wanna? Okay.
Yeah, we'll give it another minute or two and see who jumps on. Okay, I mean, we are live.
Okay. Well, we can go on and you want to go on and start, or you want to wait for Chris?
Maybe let's just give her another minute and then if
Okay.
not, we can get going.
All right.
Arizona colleague Andy Biggs says the focus in the council conversation should be centered on criminals. I will fight this. When they raise our thin majority in the House and a 50-50 split in the Senate, it's an uphill battle for Democrats to pass any control legislation. And even more difficult, remember, if Republicans take majority control here on Capitol Hill in the midterm elections. Reporting in Washington, I'm Peter Zampa. Earlier this month, Illinois lawmakers approved legislation making it illegal to sell or transfer gun parts or kits that do not have serial numbers. It would also require anyone who currently owns a gun to pay.
All right, here comes Christina.
Okay.
First used in connection with New York City in the 1920s. Megan,
What is the Big Apple?
correct.
Big before hundred?
Type of music and ensemble associated with Duke Ellington and Tommy Dorsey.
You're right. You should be I do. Oh, you retired?
Area with the state of Rhode Island.
Somebody's shishing somebody.
British call this region the Cloud.
Oh boy.
So Christina, we're live and we have enough trustees to
Yep,
get
let's go ahead and let Louis start.
Roger Miller,
Okay, I want to call this meeting of the Investment Committee together on April the 21st, 2020. It's now 4:34. Can we get roll call?
Angela Banks,
Here.
Christina Bennett,
Yes.
Louis Cross,
Present.
Sheila Goodwin,
this can be classified in two very different forms.
Is she on?
she's there, she's on mute.
Okay.
Donna Jones,
Here.
Orange County City.
Hey, Don.
Yvette Levy,
Hey.
Martell Mann, Bobby Richardson,
San Luis Rey.
Albert Sanders,
Settlements begun by the Spanish.
Justin Stein, Doris Walker,
Here.
Sheila Goodwin.
Yeah.
All right,
Okay.
well, we have 5, so we do have a quorum.
Okay. Chris, you want to take it?
No, please do. I'm in a location that's loud at the moment.
Okay. All right then. Gwelda, you and Jeff have the floor. Susan, did you have anything to say before we start?
No, we're just gonna turn it over to Gwelda and Jeff in whatever order they would like to go. We have a couple of items for tonight.
Okay, sounds good.
Good evening, everybody. I would say that we start with the media items first, and we'll go to the flash report last. But Jeff and I have looked at and done structure and manager review, and the rebalancing is also in the document that Sue's going to share with everybody.
Okay.
And then we'll do the flash report for March. I'll be going to more detail on the manager performance when we do the full performance report next month, but we'll at least let you know where things stand as of the end of the quarter this evening.
Okay, Gwelda, if I give you control, would you mind?
Jeff, do you,
Yeah, I can go ahead and flip it up. Give
Okay.
me a
Okay.
second here.
Okay. If you wouldn't mind, Jeff, you should be able to now.
Okay, can everybody see this?
Yes, I
Yeah.
can.
I'll try and blow it up a little bit. I'll back up so everybody can see, and hopefully everybody had a chance to take a look at this ahead of time. But this is the portfolio structure and manager review, and this is a more of a detailed review and some recommendations that it's really a follow on to that bigger picture asset allocation review that we covered at the last meeting. So recall that we started very high level and said asset classes and how those look and are from a total asset class perspective, equities versus fixed income versus alternatives. How do we look and are we right size? And I think the real bottom line there was your overall structure from an asset allocation standpoint was fairly reasonable and where we want to be, but certainly within that, there's the moving pieces of how each of the asset classes are constructed and the managers that make those up and what would really be the recommendations for moving those around. And a lot of this is also timely as well, because it's about time to rebalance and think about where we're getting cash for the next several months for benefit payments and expenses. So we really wanted to roll that all into one nice package here. So I'll flip over to the first page, and this is a lot of numbers. I get it, and that's why over the next couple of pages, we really wanted to lay this out from a time frame perspective and priorities too. But at least from this kind of wraps everything up into one picture, and we can take a look. And a couple of caveats I want to note here, that these are dollar values based on 2/28. So we know those have changed. We know there's things that have gone on in the market. So the dollar amounts that you see as flows in the flow column is sort of where we want to concentrate, because those are the moving pieces. So you have where the portfolio is today, and that's to the left of the 2/28. So it's not really today, but a fairly good picture of where the plan is. And then the flows, those are the movements. And then we have the proposed target allocations. But again, since some of those values have probably moved around a little bit, those flow numbers might change. So I think really what we want to focus on more are those policy percentages. And that's all the way that's to the right here. Because again, that's when dollar values change, we want to think about what things are as a percentage of the total portfolio and have those as targets. And those are really what we monitor. And then we adjust dollar values on an ongoing basis, depending on what goes on with the markets and also depending on, again, where we need cash flows on an ongoing basis and how we need to rebalance the portfolio. So those are the real focal points. But certainly want to point out from the standpoint of where the plan is today and what we see here. While we do see some dollar amounts moving around in a few recommendations with managers, and one of which is an eventual recommendation for a full liquidation, and that's on the GMO product. But outside of that, this is not really representing major wholesale moves in the large picture asset allocation of the plan. So really more tweaking of the pieces. So I need to move the pictures around here a little bit. Okay, so just a couple of things to point out again, as a follow-on to the asset allocation review at the last meeting. Really, this restructuring is designed to think about the overall risks and return of the portfolio. And here in particular, we're finding areas of the portfolio where we believe there's probably excess risk that we really don't think is getting fully compensated. So those are the things we really want to think about restructuring and moving around. So if, again, thinking of the world in net of fees, because we're paying fees, and what kind of returns we get after fees, and then are we getting properly compensated for any risk we're taking along the way. So that's really by design of what we're doing here. Certainly a benefit of a few of the things that we have moved around here. There are some fee savings involved just from the management fees. So in particular, when we look at things in U.S. equities and in those managers that are actively managed, and if we think indexing is probably going to be a little bit of a better place to be, well, that's less expensive. So that's really a good portion of the fee savings is certainly coming from having more of that large cap exposure within the portfolio indexed, as you can see, we're recommending here. And taking a look at that fee, if you think of the average fee in your U.S. equity portfolio in the 60 to 0.6 to 0.8% range, and have an index product that's 0.08, and that's also something that we certainly want to focus on as a next step, assuming that this sort of restructuring is approved, that even with something like the Mellon 500 index being very cheap at 0.08% relative to other managers, that's still a higher fee than other index funds out there. So now that if we were adding more money to this manager, that really gives us that ammunition to go back to Mellon and say, well, this 0.08 for an index product is probably a little bit on the high end, and going back to negotiate that fee, because really that fee should probably be more in the neighborhood of 0.04% as opposed to 0.08. So I know that when you just think of it in percent terms, doesn't always seem to add up or be a big number. But when you're talking about large dollar amounts to the tune of $26 million, it certainly does. It does add up and translates into fee savings. So I want to talk a little bit about how this is phased, because again, you're seeing a lot of different colors and shadings on this page. Yeah, the gray shadings, those are just the totals for asset classes. So all the way up at the top, you see the total of equity, and then below that you see domestic equity, and then all of the managers that make up that portion of the portfolio, and then international equity, and then right below that, all of the managers that make up that portion. The global equity, that's the one manager, Exponence, which is technically multiple managers, but we look at them as one manager because Exponence is making the decision on how all of those underlying components are structured. And then fixed income, again, you see that in gray, it's a major asset class, and then all of the sub managers right below that. And then the different alternative pieces. So we, for the most part, within private equity, private debt, private real estate, we've aggregated all of that, and we'll talk a little bit about that later, because again, we know with some of those managers, that's not a decision where we go in and say, hey, we can move around all these pieces really quick. We know there's less liquidity there. We know we're phasing into a lot of these managers. We know a lot of these managers take time to get invested and then start giving money back. So that doesn't move around as quickly. So with the exception of saying today, let's continue to fund towards our targets, and also with private debt, where we're saying that that's an area that we think might do a little bit better in the coming environment. Let's increase that allocation, but let's just continue on the pace we have to fund those targets. And we'll continue to talk about that throughout the year. And certainly as we get closer towards the second half of the year and taking a look at private investment pacing, because we are currently working on updating a pacing study. So we'll get a better idea of that. But again, we've been through a bunch of those. So we did fund some additional private equity and private real estate and private debt managers. So those continue to move towards those targets and to be filled out. But again, as far as major moving pieces that we're talking about today, those won't be as addressed as much today. And then right below that, you can see the additional alternatives pieces, the global tactical asset allocation managers, the PIMCO GMO, and then your hedge fund managers. So going back to the rest of the shading, so the gray being your major asset classes, and then your red, what we've shaded there to be what would be the more immediate pieces, things we want to think about doing right away. And again, those would be the primary risk reducers in this restructuring. So again, a couple things to note within those movements. Number one, it's reducing the international equity exposure as a percentage of total equity. So that's sort of a theme of what we're doing here. As part of that, that's reducing not only a little bit of a style bias that you have on growth versus value. So that Fidelity International Growth, which has been running at a little higher level than Causeway, which is a value manager, and then also reducing the emerging markets exposure to a more limited target. So all of that combined is going to reduce the overall level of international relative to US. So that's a risk reduction tool. Within US equity, where are we adding? So again, that's going back up to the top, adding roughly $20 million to the Mellon 500 index. So again, we've talked a little bit about this in previous meetings, that within US equity, the informational advantage is not as great as it can be in the international markets. And so in particular, large cap managers have the least information advantage, and they have the hardest time beating a very low cost index. So again, this sort of recommendation is really focusing on that type of evidence. And so again, we would recommend percentage wise, let's increase US relative to international. And within large cap, let's increase the index versus what's active. So again, it's low cost. Managers in that area having more of a challenge on an ongoing basis of consistently outperforming the indices. All of that, again, is designed to help minimize costs and also increase that probability of getting that good return over the full benchmark. So, and again, we'll look at some of those statistics and how those things look in some later exhibits. But ultimately, this is certainly a structure we think helps get the portfolio back in line with the overall universe. And again, it's not something we're going to talk about today, but we will focus on when the next quarterly report does come out, which will be shortly, because we will have those universe ranks in there. And so we know, as we've looked at this portfolio historically, it's held in pretty well relative to that policy benchmark. So that's the all of those passive components or index components put together at the system's allocation level, but then taking into account how well are the active managers doing, and then how well are the pieces put together. So we know relative to that policy benchmark, the plan's done well. Relative to the actuarial return assumption, it's done well, but relative to the universe, hasn't looked as good. And so again, these are some things sort of recognizing that this plan has been a little bit underweight relative to the overall universe on large cap equities. Large cap equities have done very well relative to mid and small cap over the past couple of years. And so that certainly has come through in the rankings. And then certainly within the international equity portion as well, that mix of developed markets versus emerging, having a little bit more emerging market exposure than the universe has also gone against the system relative to peer plans out there. So again, what we're doing or what we're recommending today is really to recognize that and try and right size the overall risk of the portfolio. It's not to say we don't think emerging markets at some point are going to come back and they're going to be additive to the portfolio. And we certainly think they're good diversifiers and we want them in the mix, but we also want them at the right level and right size. So let's get paid for the amount of risk that we are taking on, but let's not take on excess risk where we're just not getting paid for it. So within the fixed income portfolio, again, you see a couple of those areas that we have shaded red or more phase one items right off the bat. So again, as a primary risk reducer, increasing that core exposure. So Earnest, which has been underweight relative to Manulife, so we would recommend bringing that up to the level of Manulife, and that overall gives us more of that core exposure. So the core managers, the returns aren't as high, but the volatility is quite a bit lower, and the liquidity is better, and that's really the major role of those core pieces in this portfolio. So it's a good diversifier. Again, if we look at the past couple of months where these strategies, where everything's pretty much been impacted by what's going on, overseas with Russia and Ukraine, and what we're seeing here with interest rates going up, there's very few things that have been immune. So, but certainly we expect that normalizes, and then we get these core pieces of the portfolio being much more of a dampener, a good diversifier, and again, a liquidity generator for the portfolio. So again, from the standpoint of where we would target those long-term, total core exposure, we would look to have it around 10% of the portfolio. And again, you can see that in the policy column. The rest of the managers, and we wanted to sort of recategorize a few things, because I know we've called Exponents a core manager after we've spent a lot of time with them on their portfolio. It's a little bit different from a core manager. So they're really doing things that are very multi-strategy, opportunistic, strategic, and they were really something that we would consider more of a multi-sector. And I know Loomis, we've called that a global, and Neuberger we called a multi. But at the end of the day, they're all sort of playing on a very global basis with different areas of the fixed income market. So they really fit not only a term of a multi-sector manager, but certainly how we think of them from an overall risk profile, more of a multi-sector manager. So again, when we think of those strategies, we know that they put up good long-term returns, but we know they can tend to run a little bit more volatile at times too. So again, we want to recognize that in how we're sizing those positions. So Exponents, from again, understanding what they do and seeing how they're differentiated from the rest of the group, certainly something we think can be brought up as a total percentage. So we're looking at that as a 3% target. Loomis, it's been at 5%. Again, primarily because we think it was categorized as something different as a global manager. But I think if we bring it into the realm of really how we're viewing it in the risk spectrum, let's bring it down to a target of 3%. And Neuberger has been at that level, but again, we would look to target that around 3%. And for those managers in particular, really we take a look at their exposures that they have outside of the U.S. So they have pretty significant exposures to non-U.S. debt, and they do have some exposures to emerging market debt as well. So sort of understanding what kind of additional risks they have in that portfolio from an international standpoint brings us to think about those limits. So the Mellon tips and the EM debt, again, no major changes there. Again, those would be focused in that green area. And so again, the green shaded areas, those are really what we, sorry, I went forward a little too much. Those are what we think of as phase two. And so those are the ones we say probably not as big of a priority of scaling back and rebalancing, but those are the ones that we want to use as we look at the next few months for cash flow needs and in rebalancing as we go forward. So again, those not too far off of the overall targets that we have for them. So the tips at 3%, and then the emerging market position at 3%. So just a little bit of rebalancing would be recommended there. Keep jumping forward too much here. And then the GMO global asset allocation. So that's one we have talked about. And as we sort of take a look at what that portfolio is, it historically has been very conservative. Also historically, relative to other global tactical asset allocation managers, what we expect from that type of manager is that they are making more shorter term tactical moves in the market to try and take advantage of what could be going on in current environments. And That one, frankly, has just been a little bit more static in their allocation. And Jeremy Grantham and his team have been historically pretty bearish. And so that's always been a very contrarian portfolio that it might work in very limited environments and look pretty good. But when the markets are doing what they normally do, which is sort of trending upward in a good direction, maybe it might be during a volatile market, they tend to not keep up as much. So that's one that we look at and say, well, if they're just kind of a static, balanced allocation, aren't we better off just having it in the other pieces of our portfolio, our equity managers on the US and international side and our fixed income managers, going to work better that way? So we kind of look at it and say, if we looked at the total system as a balanced fund out there, does the total system look better than something just like GMO on its own? And the system does. So, I mean, you have very good active managers in place on the equity side, very good active managers in place on the fixed income side, and certainly on the private side as well. And so all of those pieces are really, we think are much better than looking at something that's a static, more, and I kind of look at it almost as a cash plus type allocation in the portfolio. And right now, that's our recommendation sort of how we want to treat it. So again, we have that shaded as green, so not priority, but our thinking on that is this is something that we would just draw down over the next several months, again, as we need cash for benefit payments and expenses. So Grosvenor would be the same. Again, we think the right allocation for that multi-strategy hedge fund process is about 2.5%. And marry that up with White Box, which is with your other hedge fund manager. So in total, about 5% to hedge funds. Again, those are a little bit more constrained on liquidity, but they're different, and they're good risk reducers in the portfolio. Again, that's something we'll focus on in some charts in a little bit. And again, they're additive overall to the portfolio structure. But again, we need to recognize that they're a little less liquid, and so we want to make sure that we're right sizing the overall allocation for that. So again, Grosvenor relative to the 2.5% that we would target, they're a bit over. So over time, we would say let's look to pull that allocation back towards its target, which again on this page looks to be about $10 million. The caveat on that again is they only give money back quarterly, and then you have to give them a fair amount of notice to the tune of 75 days. So we have to think of that in terms of timing and when we need the cash and how we would pull that out. So I'll pause there. I know that's a lot because the next couple of pages I'm going to break this down again a little bit more and talk about these phases. Okay, I'll jump forward here. And so we'll start on this page.
Jeff,
yes.
what you might want to mention on the previous page, we added money to PIMCO. And I know there'd been some, discussion regarding the lawsuit at PIMCO. And we did reach out to our group. You might want to comment on that.
Yeah, sorry, I need to close my shade here.
Okay.
Sun's coming in on me. Well, that didn't do the trick. Sorry. Okay. And anyway, yes, good point, Gueldo, regarding PIMCO. So I know there were some questions about some outstanding litigation with PIMCO. And some of it had to do with employment discrimination, and I would tell you that's a suit that's been ongoing for the past year or so, and at this point there's been no resolution to it. It's still being litigated. I think without getting into a ton of detail, it continues to be PIMCO's contention that there has been no discrimination in their hiring practices and in their promotion practices and their termination practices and so on and so forth. So they continue to fight it wholeheartedly. So I think from our standpoint, certainly we don't like to see news items like that. I think I hate to call it nature of the beast, but the large firms like PIMCO, and we see this quite a bit, they will be susceptible to lawsuits, whether it's for this function or whether it's investors wanting to sue for some reason or other. So, we certainly want to pay attention to litigation and make sure there's not a major issue of concern. But certainly when it comes down to employment discrimination practices, definitely we take notice about that, and we take that very seriously, and that's something we certainly don't want to ignore. So at this point, our research group has continued to follow and ask the questions of what will be the resolution there. Ultimately at this point, PIMCO continues to say that they really haven't done anything wrong. They continue to fight this with litigation. So I think we ultimately have to see how this is going to play out. So I think from the standpoint of it, is it something where we look at it today and say, well, they're completely in the wrong. We just don't have the full determination on that. Certainly something to say it's worth keeping PIMCO on sort of a soft watch until we see how it resolves. But we don't think it's at the level yet where we say we want to pull the plug too. So I think we just need to let it get resolved from litigation. See either it gets settled, either it gets dismissed. But I think at this point we really don't have the full information set.
And I'm sorry, I said increase. We're not increasing. We're not reducing PIMCO. And the discrimination is based on gender and disability status is what's being alleged. But as just Jeff said, they are saying that they have not done that. So we just have to wait and see it play out.
Great, thanks, Gwilda. Okay, so the next page, this is the phase one. So these are the items that we saw shaded red. So these would be more immediate items to address. So again, I talked about this a little bit in the overview, but Fidelity International Growth, that would be a reduction of about $5 million, and that's to neutralize the international equity style, and also helps to reduce that international equity as a percentage of the total. Invesco Emerging Markets, that would be a reduction of approximately 10 million, and that's reducing that excess risk of emerging markets. And again, this is also helping lower that overall international equity percentage relative to total equity. And then the Mellon S&P 500 index, that's adding $20 million. So that's increasing our overall exposure to the US large cap index, and also help to keep US equity as a percentage of total equity. So someone's getting yelled at there. Okay, and then moving on to the fixed income portfolio, the Loomis Strategic Alpha, there would be a reduction of 20 million, and that's reducing exposure to higher correlated strategies and also strategies with embedded international emerging markets exposure. Neuberger Berman, very similar. It's a reduction of 15 million. Again, sort of the same concept. That and Loomis tend to be a little bit more higher correlated, and also has that embedded international and emerging markets exposure. So that helps to bring down that level. And then Exponence, that's adding 13 million. So this is an increase of a differentiated diversifier within the fixed income portfolio. And then Earnest Core, that's an addition of 20 million. So that's increasing that overall core, lower risk, higher liquidity portfolio structure within the fixed income, and then utilizing the total exposure relative to Manulife. So they would both be at similar levels within the portfolio.
And just to remind everybody, when he says higher correlated strategies, I mean reduce exposure to managers that are very similar to each other.
Okay, and then phase two, and these are really the items that we would look at more for ongoing benefit payments and expenses and money that we'll need on an ongoing basis for additional private investment capital calls, and then any other necessary rebalance in the portfolio. So I put as priority one GMO. So again, the objective there is we'd be moving towards a full redemption, but again, we can do that in a phased manner over time as we need money for benefit payments and expenses. Lazard emerging market debt, that's a $5 million reduction. I marked that as priority 2. Again, sort of keep that in the docket for the next couple of months when we need money for benefit payments and expenses. Priority 3, Mellon Tips, and then priority 4 is Grosvenor. So again, I talked about before the liquidity on Grosvenor being quarterly, and then them needing 70 days notice for getting that money back. So I initially, we had targeted 12/31 for that, and we just recently had a conversation with Sue about cash needs, and we might want to push that one up. So I think on that one, we could potentially be targeting a 9/30 redemption date. So, which would mean they would need notice 70 days prior to that. But again, that's a priority 4 in this overall structure. Really, again, as we need that money for benefit payments and expenses, that's really how we prioritize there. So, any questions on the timeline? Okay, I'll jump forward to the next page, and we wanted to put this in here. These are just the proposed allocation policy targets and ranges, and this is really this format here is taken directly from the investment policy statement, and this is I just wanted to throw out there as a reminder that certainly what we're recommending today as far as target allocations and ranges would become a part of the new policy. So we are in the process of updating the investment policy statement, and this would be the proposed table for allocations that would be within the policy document. So you can see the targets with total equities and then each of the components at 48%. Global asset allocation is at 3, fixed income 25%, hedge funds 5, real estate 7, private equity 7, private debt 5. And again, you can see the ranges. And again, for the most part, those haven't changed drastically from where we currently are today. May have tightened up some of the tolerable ranges in a couple of the areas. But again, really the objective here and why we show these exposure ranges, because these are really our rebalancing guidelines. And again, Gwelda, when she goes through the report, will show the chart that has the allocations and those ranges and where we look. But that's really our tool to look at and say, do we need to rebalance something? So are we heavy on equity in this area? Are we light in this area? And how do we right size those? And generally, the way we're always looking to do that is through regular benefit payments and expenses, pulling the money from the areas that might have a little too much. If we have excess cash, putting it in the areas of the market where we're a little bit lower than these targets. But again, these are important always to keep in mind. Certainly if these do get approved and within the policy, then these updated targets and ranges would then translate into the monthly and quarterly performance reports. And so we would be tracking relative to these new targets and ranges. Okay, I'm going to try and get through this fairly quick because a lot of this is going to end up being repetitive, but just within, this is a little bit more rationale behind some of these recommendations. But within equities, again, we talked about large cap managers. They continue to face these challenges. And so that's why we really think adding a little bit more in passive, it makes a lot of sense there. International, again, why we would lower that allocation in the total equity construct. There's a few things going on that certainly are going to be headwinds for international markets for the next couple of quarters. Certainly what's been going on with geopolitical issues, Russia and Ukraine, and certainly some of the ongoing overhang from COVID and definitely with the Fed and their interest rate tightening. And that one's a little bit trickier, but I guess the easiest way to think about that is when the Fed is raising interest rates, generally that means our debt becomes more attractive, sort of medium to long term for international investors, and we can get higher interest rates over here. So a lot of foreign money starts to come back into the US. Well, ultimately that pushes up the level of the dollar. And why that's an issue for an international investment, particularly one that's translated in dollars, is when you go out and invest in an international market, you're investing in their currency. But ultimately, when that money comes back and you have to do all of your accounting, you have to translate it back into dollars. So you have to buy dollars at the end of the day. That's sort of how to look at it. The higher the value of the dollar is going, the less dollars you can buy when you're bringing it back here. And so that's sort of an inverse relationship. So if the dollar's going up, that's actually going to be a headwind or a negative for your overall rate of return. So something we take a look at and certainly want to think about of the overall risk and the level of the international markets in the total portfolio. So again, bottom line on those recommendations in the US, increasing that large cap exposure and also looking more at passive, and that's through the Mellon product that we're increasing. Also, we've talked about Intech, and we know that manager has been on watch. They've had some organizational issues. Performance more recently has been a little bit more choppy relative to the benchmark. So that's a manager we want to continue to keep an eye on. And again, we'll take a look at some numbers in a little bit, but for the most part, over the past 5 and 10 year periods, Intech's been very much like a large cap growth index. So after netting out their fees, are they adding much more value over that benchmark over time? That's certainly something we want to pay attention to. They've been index-like. It's not a manager that's been really hurting the portfolio at all. It's been good large cap growth exposure, but would we be better served at some point with a different either active large cap growth manager or just indexing that exposure altogether? So something to keep in the mix. We, again, not making a recommendation on that today, but certainly as that manager is on the watch list, something we want to continue to think about over the coming quarters. And again, decreasing that international exposure as a percentage of total equity and limiting that emerging market equity risk. So fixed income, again, we focused on the past couple of meetings on what's going on with interest rates and what the Fed is doing. And again, we know that inverse relationship is short term. When interest rates are going up, it tends to be a negative for certain areas of the fixed income market. So certainly we want to continue to be sensitive to that, but we also want to be sensitive to, we still need liquidity and diversification and things that really dampen risk in the portfolio. So again, we think about that in that core allocation and the earnest allocation. And the valuations within some of these other markets, high yield, triple B credits, again, some of these things that a Loomis or a Neuberger are heavily focused on, some of those valuations are starting to get pretty full. So again, we think about that in the overall mix of how we're looking to position those types of managers. So again, we're looking at limits on those types of strategies. And emerging markets, again, we've had this discussion of not only the Russia and Ukraine effect and what that's doing to emerging markets right now, but certainly a lot of the things that have been going on an ongoing basis with China and their major impact on the emerging markets. So again, we know it's a volatile asset class, hasn't looked very good of late, but certainly something we want to continue to have as a diversifier long-term for the portfolio. But again, let's make sure we're not taking on excessive exposure. So bottom line, increasing the core fixed income exposure for the recommendation, and then limiting those non-core and less diversified strategies within the portfolio. And the next page, the global asset allocation to hedge funds. Again, I talked a bit about the GMO and certainly being more of a static balanced fund and not being more of a value additive relative to not only the other active managers within the portfolio on the equity and fixed income side, but also relative to a manager like a PIMCO, who is operating more like a hedge fund, and they are very different and really offer something different to the portfolio. And then the hedge fund managers themselves, White Box and Grosvenor, again, operating very different in very different areas of the market. Good diversifiers, good risk reducers within the overall portfolio construct. And then alternatives, and we'll talk a little bit about some of the aspects behind this later, but with real estate, again, we've had some additions to that space, and certainly continues to be a very good market. So we want to maintain the allocations that we do have there. The yields that we're getting within the real estate markets are much better than what we're seeing in fixed income. So certainly that spread is going to tighten up as interest rates and fixed income are going up, but for the time being, still a very good place to be. Also, some of the things that were more of a concern during COVID, in particular office space and retail space, and some of these things that were a little bit more depressed have now come back quite a bit. So there's still a lot of positive things to look at and think about in the real estate market. Private equity and private debt, those valuations look really good. So even despite some of the sell-offs that we've seen more recently in public equities and in public debt, those valuations are still somewhat full and high. So relative to that, if we're going into the private markets, we're still getting pretty good deals. We're getting in on a good ground level, and what would I'd say on the cheap for getting into the private space. And so again, good diversifiers for the portfolio, good long-term return generators. But again, we know they're less liquid. So again, all of the targets that we have in place and the ranges really recognize that lower level of liquidity. And I'm going to try and flip down without losing my page here. But again, as I discussed before, the overall recommendation, let's continue pacing towards the targets within those private spaces. And then part of that is also increasing the private debt target to 5%. So we're currently at a target of 3, so that would bring us up to 5. And again, I'll show a chart a little bit later that sort of explains why we want to think about making that type of move.
So what is your, I'm sorry, this is Christina. So what target timing would we do for private debt?
Yeah, that would be, again, we'll really want to focus on that as we do a pacing study and how quickly we can do that. Because really, again, the major trick there is just the timing as to when managers, and we can look at our current managers for number one, just to see if they have follow-on investments that are coming out, because that's sort of the first place that we would look, and that's kind of the easiest thing to do. But also just from our research group, they're always out there trying to identify the next favorable deals, what's recommended, and again, what the timing is. So I would say and Gawalda, correct me if I'm wrong, but for a 2% increase in that allocation, it might be something that we'd think about for the next 12 to 24 months.
Yeah, you're
Okay,
correct.
thanks.
Yeah.
Thanks.
Okay, and then the final bullet I have on there is just thinking about potential core and non-core replacements for UBS Trumbull properties. So again, the system has allocations to 2 UBS products, one of which is performing better than another, both of which have actually been improved. I know this is one that our research group hasn't been all that hot on from the standpoint of there are better managers out there that they are recommending, but I think from the standpoint of they've certainly turned the corner a bit on stemming a lot of the redemptions that they've had coming out of their fund and restructuring the portfolio. So there has been some improvement, certainly on the other UBS product that's performed a bit better. But the property fund, again, that's one we would keep an eye on and say maybe we think about replacement. Again, the trick there is while they have pulled back some of the redemption activity in the plan, there is still a redemption queue. So even today, if we said let's put in a full redemption, it could be a while before we get all of that money back. So, something to think about, and again, something we'll think about when we take a look at the overall pacing for private investments.
So I know we've been trying to get out of the UBS fund for quite a while. And again, we talked about this before, but if we gave notice or if that was a recommendation, how long do you think it would take to get out of that fund? I mean, it's not losing money, right? So it's just not performing.
Right. No,
Other things.
you're right. And again, their biggest issue is that they've been battling these redemptions. So again, if I were to ask them today what they thought, I'm sure they would probably tell us 12 to 24 months. Now, whether or not that's the actual time frame, we don't know. I would tell you that I've had, and I think Gwelda has had clients also that have been in the redemption queue. I've had clients that have been in that redemption queue going on 5 years now. So it's been taking a while, but again, that as the market has been more favorable for real estate, as they've been able to pay out some redemptions and restructure their portfolio, that's going to get better. And it's one of the unfortunate things about the liquidity and the timing on these types of investments. It's by the time you get your money back, is probably the time you want to put it back in. So that's always the real challenge with these. So, again, I can certainly send out a message to UBS and say, what is your current queue? What's the expectation if we had an X dollar redemption? What would be the timing expectation? So we can report back to the board on that.
I was going to say, I would need to get an update, but I did talk with them a couple months ago, and it was around 12 months. And it's going to be a pro rata reduction because
Right.
there are quite a few people that have put in redemption requests. So it's going to take some time. So, I think Jeff and I would probably recommend that if you want to start to liquidate this, as we are recommending, that we go ahead and put in a request, because it's going to take some time to get that money out of there.
Yeah, I mean, if you recommend that we just put in, redemptions every 6 months or so to get in queue so that it creates some liquidity. If we can't liquidate it all at one time, then I guess we could stagger it, ladder it, whatever, to be able to either generate some cash for cash needs or deploy it. But if you're not going to get it in big chunks, then you can't deploy it, right? Effectively.
Right. And again, I think everybody in this industry doesn't like to be the one that does this, but it's out there and it happens, and and we do it. But you can put in a full redemption, and if it gets to the point where they say, hey, we're about to give you all your money back, and if it looks like things have turned around and it's good and you want to rescind the redemption, you can certainly do that.
You can do that.
Okay, I'm going to jump forward. And I'm going to try and be somewhat brief on this, but I know that I throw the term correlation around quite a bit, and Christina, I know you've talked about this a bit before too, and just understanding these correlations between managers and what all of that means and where we might have overlap. But again, just to talk about this chart you see on this page. So these are all of the U.S. equity managers, and then some key indices that we look at. So right below you see number 8, 9, and 10, the Russell 2000. So that's an index, Russell 1000, and value, Russell 1000 growth. So those are going to be some key benchmarks for the U.S. equity managers that we look at, and you can see again, those correlations. So, and again, to read that table and think about correlation. So any number that if something is a 1, that means that they move perfectly together. That means if a manager's up 10%, then the other manager's up 10%. If it's a little bit lower, like a 0.5, then manager A is up 10%, then manager B is only up 5%. So that's kind of a simple way to think about correlation. And then when they start to get a lot lower, and you're not going to see any examples on this page of negatives, but negative correlation would really mean if there's a manager has a positive return, then the other manager that's negatively correlated would have a negative return, and they would really act lockstep. So again, why are these numbers important? Because when we put managers together, we want to make sure they're doing different things, and we want to make sure that when markets are kind of acting crazy, that we have a mechanism in place, and that's diversification. So really, by rule, the lower these correlation numbers are, the more they benefit diversification of a portfolio. So managers that act differently actually help to offset each other's risk. So that's why we look at these numbers. But again, I always like to caution too that they're just a statistic. They can be very time period dependent. I tried to get as long as a time period I could for all of these managers we're looking at where they all had track records. So this was 10 years, and for most of these we're going to look at, we have 10 years that we can take a look at. But again, these can change. And what's also important to know with correlations is that these are static. This takes a look at time series of rates of return for a 10-year period and calculates how they act together. But what really doesn't get captured in this type of analysis of looking at correlations is that when the markets are stressed, such as we've seen fairly recently, that things that on this page aren't necessarily correlated, they will correlate very highly. So correlations are not static, and during periods of stress, they all tend to go towards 1. So now with the U.S. equity managers, again, you'll notice a lot of higher correlations. And again, that's just due to the fact that even if a manager has a completely different portfolio of stocks relative to other managers in this space, that when we have periods of stress, or when the world is selling equities, or when index funds are going in and rebalancing their portfolios, it impacts a lot of different equities, and it impacts them very much all of the same way. And so U.S. equities, more than any asset class, tend to have higher correlations. So we always have to think about that and understand that we're not going to have, for the most part, very low correlations or even negative correlations. But really what we want to think about is, do we have different sectors covered? Do we have different styles like value versus growth covered? Do we have different capitalizations, large, mid, and small covered? And and more importantly, do we have what we call manager specific risks covered? And that's just due to the fact that we could say, hey, let's find our best manager in the mix today, and would we give them all of our money? Well, no, because if we give it all to Westfield, or pick a manager, TCW, and something happens at TCW, a portfolio manager leaves, or some scandal breaks out, or something crazy happens with a manager, we have manager specific risks. So we want to diversify those things out as well. So what happens operationally with these firms, what happens with teams, and how they manage their strategies, operations, so on and so forth. We want to have all of those things diversified as well. So again, just from the standpoint of what does stand out here, certainly you see something like a TCW at a 0.5 correlation to one manager. And again, how to read this too. Sorry if I didn't explain this, but if you go down the left side, it's each of the managers, and then if you go along the top, each one of those numbers corresponds to the managers on the left. So if you look at take one, which is Edgar Lomax, go all the way across and then meet one. Well, that's Edgar Lomax versus itself. So it's the same. They against each other. It should be a correlation of 1. So when we go down this diagonal and see all of those ones, that's each of the managers or indices relative to itself. So those should all be 1. So let's read 2 different managers. Let's go down to line number 2, systematic, go straight across. And then that box is systematic relative to number 1, which is Edgar Lomax. So Edgar Lomax relative to systematic is a 0.9 correlation. So again, fairly high level of correlation, but probably what we would expect within US equities. But go down to number 3, and this is a bit of a standout. So this is TCW at a 0.5. And then what are we looking at them relative to? Well, again, that's the number 1. So number 1 is Edgar Lomax and TCW. So 2 pretty good complements within the large cap space at a 0.5 correlation. That is fairly low. And as you can see, relative to the rest of everyone else we're looking at, another sort of standout that we see in the same level. Let's come down to number 5, which is DFA microcap. Come all the way across to see that 0.47. That 0.47 is right under the 3. Who is number 3? Well, it's TCW. So again, TCW as a large cap manager having a nice offset to DFA as a small cap manager within the portfolio. So again, these are interesting to take a look at because it is something that leads us to take a look at managers. And when we see things like 0.9s and things even higher than that, 0.95s and 0.98s, those lead us to dig into the portfolio and start to look at actual positions. And do they have, is everybody investing in Microsoft? And is it too much of a concentration in the portfolio? Or is too many managers have high concentrations in Apple or Coca-Cola or any of the names? So we just want to make sure that if we're seeing high correlations, that they're more just based on market movements, pushing those correlations together, as opposed to the actual portfolios themselves being almost identical. So, and again, as we take a look at all of the managers in this portfolio, we're not really seeing any major concerns of those types of overlaps.
Jeff, Christina had her hand raised. I'm not sure if she had a question.
Oh, I was just going to ask him as he was reading this to explain how to read this chart on the correlation side. And then that was my question. So he answered it when he started to explain it, but I just wanted everybody to understand how to read this chart.
Okay. Did that, Christina, was that a feasible explanation?
Yes. So it looks like when I look at this chart that we have probably, I would guesstimate, probably like a 6.8 to 7 average correlation in these managers. Maybe with the low one on a few being that TCW, but I didn't see anything that jumped out.
Yeah, that's fair. I mean, you know, the ones, like I said, that we would probably pay most attention to would be just if you look at DFA microcap and scroll over and relative to number 2, so that's going to be systematic and seeing that higher correlation. So, you know, we would look at that and say, okay, that makes us dig into the portfolio. But what I would tell you there is because of the market volatility that we've seen and that small caps in general have been out of favor over the past couple of years, that anything small cap has been fairly highly correlated. So again, we would expect as we go through time, longer time periods, different market environments, that those portfolios will be probably a bit more complementary than the actual figure shows us here today.
And did you mention where those correlation numbers come from? Is there like a some type of agency or something?
Yeah, so these come, so we use a portfolio analytics system, and there's a lot of different systems that do these. Morningstar does them. We use a software system called Investment Metrics that calculates. So it is third party. So we're not, the manager doesn't calculate it. We don't do it. It's independent from a group that does this, has expertise in doing it. But in a nutshell, what they're doing is there's a mathematical formula that just takes a monthly series of the rates of return. So if you take a time series of monthly returns going back 10 years and lay two managers next to each other, there's a formula, the mathematical formula that says, okay, every month, how much are these two return streams the same? So the more the returns are the same on a month-by-month basis, the higher that number is. If every month you go through time, the numbers are very different, then those are lower. So like again, like a DFA microcap and a TCW that has that lower than 0.5 correlation, if you just take a look at their monthly returns, they're going to be fairly different as we go through time.
Thank you.
And also, Angie, what it does too is it looks at the holdings and it looks at the percentage of holdings and the overlap, so that while one thing may say core value, one may say core, there used to be less categories, and with time that we've split categories up into subdivisions, and so correlations just people used to do it by hand and by Excel spreadsheets, but now it's all formula driven, and so you can see where the weightings may be the same, and then takes that risk into account. So luckily it's all automated now with formulas.
Yeah, it is. And again, I know this kind of gets overwhelming when we have so many numbers on a page, but yeah, thankfully, as Christina said, there's systems that do this for us. And I know Gwilda and I have been around and have done this long enough that back when we started out doing this, we were creating those spreadsheets, and we were making all those things work on Lotus 1, 2, 3. So.
We date ourselves if we say Lotus. I loved Lotus.
How about Lotus 1, 2, 3, and then to put together a chart like this that you see? Remember, we had to use Harvard Graphics.
Harvard Graphics.
Ooh, we're dating ourselves.
Yeah. Okay, I'm gonna flip forward because I did these risk return charts on a 5 and 10 year basis, but I just in the essence of time, I'm going to skip over to the 10-year because it's our longer time period here. But again, we've looked at these risk return charts in a couple of different analyses before, and we have these statistics in the quarterly reports, and it's always something we like to pay attention to here. But again, how to read this is that on the bottom or the horizontal axis, that's the standard deviation, or that's the risk. So that's the choppiness or how volatile the manager's return stream is on an ongoing basis. So the further to the right, that means the manager is more volatile. When you go over to the left, that means the manager displays less volatility of their returns. And then on the vertical axis, those are the rates of return. So annualized rate of return over a 10-year period. So again, we like to be higher. We like to get more return. And we also like to do that by taking on less risk. So if you think about this in quadrants, and where do these quadrants come from that I'm talking about? Well, these blue lines, that's the Russell 3000 index. That's what we think about as the full US stock market index. So when we're constructing the US equity portfolio, we want to have all of those characteristics of the Russell 3000 represented. We want to have large cap and mid cap, small cap, and value versus growth. We want to have all of those areas represented in a similar fashion to the full market, which is the Russell 3000. So that's why we tend to use that as sort of our center point. So the crosshairs would be the Russell 3000 index. So when you're in this upper left quadrant, you're going to be displaying less risk than the full market of the Russell 3000, and you're going to be generating a higher return. So this is sort of this is the ideal quadrant that we want to be in for, again, as a total portfolio construct. Single managers, you want to look at them more relative to their specific styles, but I wanted to simplify this and not do a bunch of different charts with different index crosshairs, but and we'll get to what the total portfolio looks like in a moment. But at least we can see managers, we can see who has the most risk and the most return in the portfolio, and think about, again, how we're sizing things in the overall construct. So you can see TCW is going to be the furthest to the right as far as risk. So they're taking on the most risk, but you also see that they're generally higher on the vertical than all other managers. So they're getting compensated for that return. Now, they're a large cap growth manager, and we've put their index in there. So that's this circle here that the Intech is sitting right on top of. That's the Russell 1000 growth. So if you think of TCW taking on more risk than their index, but also getting paid for it in excess return. So you certainly want to pay attention to that index. Again, Intech, we talked about before, that it is an active manager, but you see not much different in overall characteristics on risk and return than the broad Russell 1000 growth index. So just something to think about as we continue to monitor them. Is there someone that we can get into the mix that's going to be moving more up on the vertical, but not not taking on a ton of undue risk? In particular, if we want to pair it against the TCW. TCW is doing great. We like the return, but they are adding some volatility to the portfolio. So to have a dampener in there makes sense. So I'll come down to the value.
Jeff,
Oh,
Jeff,
sorry,
I don't think we had TCW in 2009 when the market went south.
Okay.
I don't know when they came on, but I was after 2009, I believe.
Okay, and that's a good point to make too, because for this analysis, this is these are taking the long-term track records of each of these managers' composites, so we can evaluate them today, and is sort of agnostic as to when they were brought into the portfolio. So This just helps us kind of have a look back of saying, even though we didn't have TCW 10 years, this is how they've looked over the past 10 years.
Yeah, you brought them on in 2012.
Okay, thanks.
So, and again, really the concept here is to try and gauge all of these managers' risk and return characteristics by looking at a longer time period. Because again, if we were to take a chart like this and show you a 3-year or even a 1 year, these numbers are going to be completely different because of, again, just the general level of stress and excess volatility we've had in the market. So the longer we can go out for these types of time frames on these managers, gives us a better sort of normalized gauge of over time how these managers act. So Mellon, that's the index product. So as we would expect, should probably be pretty close to the crosshairs. Now that's an S&P 500 index. So it's going to act a little bit differently. And so why would that be a little bit lower risk relative to the crosshairs that we see, which is the Russell 3000? Well, the Russell 3000 is more full market, so it has mid and small cap. Mid and small cap, more volatile. And again, for this 10-year time frame, have been more out of favor. And so if you're S&P 500, lower volatility in that overall construct. But that's the index fund, that's Mellon. Going down the level, that's Lomax. Now, again, while they're sitting below the overall Russell 3000, what we want to take into account is that value has very much been out of favor relative to growth for not only the past couple of years, but if you start to factor in that level of underperformance versus growth for the past 10 years, we certainly see that. So that's why, again, I wanted to place the benchmark in there as well, which is that circle. So that's the Russell 1000 value. That's the Lomax benchmark. So they're about on par return wise, but you see they're operating at a lower level of risk. So again, that's good. We like to see that. So if you're at the level of performance or maybe a little bit low, well, are you at least adding some portfolio dampening within the mix? So, and then you can see your small cap managers, small and mid cap managers, Systematic, Westfield, and DFA. And again, they're all going to be sitting fairly close to that circle, which is the index, the Russell 2000 index. And all of them are above in return, so that's good. We like to see it. 2 of which are actually operating at a lower level of volatility relative to the index, and DFA just a little bit more volatile in that mix. But again, they're getting compensated for it in higher return. And again, if you look at those 3 managers as a total construct and how they can offset each other in the overall mix, they're all doing a very good job of that. So I'll flip forward to the next page because this really talks to the structure. So these 2 boxes are, if you take all of those managers, and again, this is sort of being agnostic of when we actually hired those managers, but let's just saying if we had all of the managers that we have today for the past 10 years at the current allocations that we have them, what is their overall risk and return? And so you can see that. And again, you can see relative to the Russell 3000, above the line, adding value, and but operating at a little bit of a higher level of risk. And again, a portion of that's going to be because of that higher level of volatility from TCW. But again, that's been a higher performing manager as well, and some of that mid and small cap exposure in the portfolio. So that's the box to the right is the current, and then the other box that moves a little bit further to the left and actually dampens the risk a little bit, that's the proposed. So if we take a look at the allocations that we're proposing today for the U.S. equity portfolio, this is where it would land. So again, not a huge shift, but it is really serving that purpose of lowering the volatility in the portfolio. And again, some of that's really going to be adding more of that lower volatility S&P 500 index exposure within the portfolio, and also increasing large cap relative to the mid and small cap in the portfolio. Okay, I'm going to jump forward, and for the international equities, again, a similar set of metrics that we're showing here. So you can see the allocations, and again, I would say for the 10-year period that we're looking at today, these correlations are going to look a bit higher. And again, just a lot of that having to do with the fact that international in general, no matter what these managers are doing, no matter what their style is, how much they're developed and emerging, it's been out of favor and has had more pressure on it. And when those strategies are more out of favor, they tend to correlate a little bit higher, no matter what's in their portfolio. So something to think about when we see these higher numbers here, and say, well, we still think that between a Fidelity and a Causeway and Invesco and Dimensional, we have a lot of good bases covered, from capitalization, large, mid, and small, to developed versus emerging, and style, value versus growth. We have a very good level of diversification, and then all the way down to holdings, and understanding that we don't have any major significant holdings overlaps within these portfolios to cause us concern. To the extent of where we see a little bit more risk in emerging markets, we want to think about capping those exposures. And then again, with the style specific managers, Fidelity and Causeway, reducing that excess growth exposure we've had relative to value. And we'll take a look at risk return. I actually did this for 3 periods. I did a 5 and a 10, but I felt that for this one, since we had enough data for most of the managers, that it might be insightful to take a look at a 15-year, because that just gives us a little better view of where emerging markets can add some value in the overall construct. So again, here, similar to what we did on the US, these crosshairs are the representation of the full market for international. So that's the MSCI All Country World ex-US. So that's the full international market, developed, emerging, value, growth, all capitalization styles. So again, when we think about how we want to build and maintain an international portfolio, it's to have characteristics not too dissimilar from the full market, but then having the ability to add value over that full market with the active management that is employed. So here you can see where value again has been very much out of favor versus growth. And those are two indices. So that's the EAFE or developed growth, and then the EAFE or developed value indices. You can see where Fidelity is. They're a growth manager. So they're, again, from this time period and a risk reward standpoint, we'd certainly like to see them operating a little bit closer to their overall style, but relative to the full market, they've still been adding value and doing it at a bit lower level of risk. And then for the emerging market managers, again, not surprising. We know emerging markets are more volatile. You can see the emerging markets index, that's the circle. And then you can see DFA, and then Causeway as your value manager, you can see relative to their index, which has been significantly out of favor, adding a lot more value. Now, they are doing it at a higher level of volatility, but they are getting compensated for it. And then your Invesco product didn't have enough data on it for a 15-year period, but you can at least see where DFA is about at the level of return, but operating at a higher level of volatility. I can jump back to the 10-year because we can then see where Invesco is in the mix. But yeah, you can see DFA for this time period not as good, operating at a higher level of volatility, but also underperforming the market. And your Invesco operating nicely at a level of return higher than the emerging markets, and also doing it at a slightly lower level of overall volatility in the portfolio. So again, sort of wrapping it all together, what does this mean from a construct? So we'll flip over and take a look at a similar analysis. So for a 10-year period, again, we're taking the managers currently, and that's the blue box, and at their current allocations, and running it back 10 years. And then if we do some adjustments in the portfolio, you can see it doesn't move that much, and it actually moves a little bit more towards the right, but again, probably not a meaningful movement. And really thinking about it on a forward-looking basis, that something like a TCW, if we pull back Fidelity, which has been lower volatility in the mix, but also performing a little bit lower, and TCW as a proportion gets a little bit higher, that's why we see that shift a little bit to the right in risk, but ultimately not a major movement. But at the end of the day, with this construct, it looks really not all that bad relative to the overall market, certainly operating and generating a higher level of return, but doing it with taking on a little bit more risk than the overall market. But again, the concept here is if we are going to operate at a little bit of a higher level of risk relative to that market, let's make sure that we're getting paid to do it. And here again is a proof statement that we are. Okay, let's jump over to fixed income. And again, so these numbers you're going to see are on a correlation basis, quite a bit of a different story. So you can see some very low numbers. So this is really an area within the portfolio that you can really add a lot of diversification and a lot of risk reduction and dampening by having a good subset of managers in here. And I think this is a pretty good proof statement that we really have that in the construct. So certainly, what does stand out again is if you take a look at an Earnest and Manulife, those are both of your core managers. So if you look at Earnest and go all the way across, and then look where it is relative to its number one, which is the Manulife, that's going to be your higher correlation. And that really is going to be due to the fact that there tends to not be as much differentiation in very liquid core managers. So they can have some differences in how they manage the corporate securities that they select, and some of the mortgages that they invest in, and the treasury securities. But because it's all very high quality, and again, also think about the information flow within that area of the market being somewhat similar to US equities. There's not as much of an informational advantage in that area. So you sort of give up a little bit in diversification to gain what you get in risk dampening from those managers. and also that cushion in the portfolio in those extreme downside periods in the market. But outside of that, when we see a lot of these very single digit, low double digit type correlations, those are good. We like to see those, and that really tells us that we have some good differentiation, particularly amongst these multi-sector managers, Exponence, Loomis Sayles, and Neuberger Berman. So again, I will jump over for risk and return to the 10-year period. And what we've done here, again, just for the purpose of coming up with some quadrants to think about, we've used the Bloomberg Global Aggregate. So that's the global fixed income market. That's U.S. and non-U.S. bonds. There's emerging markets in there. There's all different sectors, corporates, governments, everything else. So it's a really a good gauge of global fixed income and overall return and risk. And really, I think the great news that we take a look at here is every manager within the portfolio is adding significant value. Some of them doing it at different levels of volatility. Lazard on the emerging markets front is going to be the most volatile in that mix. But again, that's what we think about when we size something like a Lazard and an emerging markets allocation to think about limiting that. But they will give us return. They will be a good diversifier for us. But we also have to recognize that it's going to operate with a higher level of volatility. Neuberger sits sort of at the highest in return and sits at a similar volatility level. And then all of the other managers in the mix are actually very good volatility dampeners within the portfolio. Manulife and Ernest, again, we talked about those core managers and that they really are your risk dampening mechanisms and good liquidity providers within the portfolio. And again, you can see that here where they generate some pretty good returns relative to the other managers in the portfolio, and they're doing it at a lower level of risk. And then you can see where your Mellon Tips product is as well, operating at probably the similar level of return on a longer term basis as Lazard, but certainly doing it at a much less level of volatility. So again, putting all of those together and thinking about it, and I like this chart the most out of all of these, because if you take a look at our current construct of where our allocations are with these managers, here's where it sits. And if we do some reallocations, limit some of those emerging market exposures, bring back some of that global exposure, increase that core exposure, we're still operating at about the same level of return, but we're actually dampening risk. So, and again, I know from a standard deviation of a 3 to 4 is not a huge leap, but again, just to think about in the overall terms of what we're trying to do is, take on a reasonable amount of risk and get paid for it, and think about areas where we can really optimize. We're certainly able to do that here in fixed income. Okay, I'm going to try to get close to wrapping up here because I know Gwilda still needs to go through the report. Again, what we did here is put together the global allocation managers and the hedge fund managers, because at the end of the day, we sort of think of their risk and how they're operating as the same. They're all operating in global markets across all asset classes, and they're really trying to be differentiators and from that correlation standpoint. And again, what we talked about, if we have two managers in global allocation, let's make sure that they're, and particularly in this space where these managers can really go anywhere and do anything, we expect to get some sort of a correlation or lack of correlation benefit, I should say. And if you look at PIMCO and GMO, they're fairly high at about 0.93. So again, if you think about them playing in the same sort of space, but needing to act differently, again, we think PIMCO does a much better job of being a little bit more tactical, changing the portfolio and operating more like a differentiated multi-strategy hedge fund relative to a GMO that's been a little bit more static in their allocations. And then again, you can see where Grosvenor and Whitebox, those are actual hedge fund strategies. And Grosvenor in particular with a negative correlation relative to GMO. Also a fairly low correlation relative to PIMCO, almost at a zero level. So again, what we would say is a very nice diversifier within this mix. Whitebox operating a little bit higher on some of the correlations. And again, some of that will be just they've been a little bit more equity focused in their portfolio over time, and some things that have tended to correlate a bit higher. But again, they've been, and as we'll see on a couple of these pages, just different from an overall risk reward standpoint, and certainly something that dampens risk in the portfolio. So taking a look at the 10-year, and again, what I used as sort of the guideline or the crosshairs here is a 60-40 asset mix. So that's 60% of world equities and then 40% of world fixed income. So again, these managers can look very different than that, but it's just sort of a guidepost that we would look at to say if we were to deploy these managers' capital elsewhere, this might be one way we think about doing it in a 60-40 mix. So just probably as good a benchmark to think about as any for these types of managers. So you can see where PIMCO and GMO not too far off of the overall risk of that 60-40 portfolio, operate just a little bit more volatile. But they are definitely, for at least this time period, their returns have been lower than that mix. And I can tell you that a good portion of that is just going to be due to, and this really goes for all of these managers, that their equity exposure has not been as high as 60%. Most of these managers, Grosvenor, Whitebox, and PIMCO in particular, can also take positions that are actually, we call them a short position. That means they're actually investing opposite of what the markets are doing. So again, that's another tool that can reduce risk. And we can see from at least a risk standpoint, Whitebox and Grosvenor have done a very good job of that. So they operate at very good low levels of volatility, but are also generating pretty good solid returns. So 6% for this time period for Grosvenor and getting close to an 8% return for Whitebox. So for operating at those low levels of risk, still getting good return. And again, as we saw from correlations and what we know from their holdings, they are very good diversifiers in the portfolio. But again, from the standpoint of a PIMCO GMO, probably not as favorable on having a higher allocation with two managers there. Certainly, we think PIMCO can be value additive over time, and certainly it's going to be at a lower level. So from the standpoint of global TAA, which was previously at a 5% level, we would target that to be lower for the overall portfolio. So we would keep PIMCO. Again, think of them more like a hedge fund in the overall allocation and risk spectrum. But then really at this point, not think about adding someone to replace GMO. Okay, a couple of things I want to point to on private markets. Again, I talked about the valuations before. And again, here's a little bit of a historical look at valuations. And again, when I talk about these numbers and when we look at these, it's a lot of statistics, but really the easy way to think about this is from an investor standpoint. The lower those numbers with the X behind them, the better deal that we're getting as an investor. So we're really the more room that we think something has to grow, or more upside that it has today. So that's sort of, if it's priced, if it's at a good price relative to our expectations, that number is lower. So again, what's the important thing that we're trying to focus on here? It's that in private equity, so that's an allocation that we do have in the portfolio, and we're talking about continuing to pace and make sure we're adding and getting to our target allocation there. And that's important because the private equity markets have those lower multiples. So right now, relative to the S&P 500, which are the large cap stocks, Russell 2000 small cap stocks, those have run very well over the past couple of years, and they've become more expensive. So if we're getting in, maybe we don't have as much upside. Whereas the private markets that have those lower numbers, they're a better deal today. So getting in there, we think we have more room to grow within the portfolio. So again, we continue to like the target we have for private equity in the portfolio and want to continue pacing towards that. The bottom chart is somewhat interesting because this takes a look at how some private strategies, and this looks at equity and debt type strategies and even real estate, have done in rising interest rate environments. And so those dark blue funds, those are actual funds that started or started raising capital and starting doing their deals in rising rate environments. And then the all other funds, those are just funds that actually started and operated in other environments. So but really gives us a good look of if a manager actually started their strategy and started investing in a rising rate environment, which ones did better. So we can see from at least the private equity type strategies, secondaries have done better. And secondaries, those are deals that the manager A goes out and finds private equity deals that have already been out there and have already been operating for a while and buys them from somebody else and brings it in. So they've already gone through a lot of that initial risk. They're now generating a lot more cash flow. Volatility levels on them tend to be higher. That's a secondary type deal. So though from the equity standpoint, those have done better. But by and large, it's the debt strategies, so distressed, mezzanine, and then the real estate strategies that have really done the best. And so again, when we take a look at those overall targets and think about bringing the private debt category up from a 3% level to a 5%, this would definitely be strong evidence as to why we would think about doing that, because we are going into what potentially could be a longer term rising and higher interest rate environment. And certainly some of those strategies within private debt, it can do much better for us. And the final page, and again, I'm not going to go in depth in a lot of these statistics, but again, just more of some reinforcement of real estate and why we like the current target and why we certainly think it makes sense to continue with the targets and allocations that we have in real estate. And certainly we can see from the top chart, this takes a look at a few metrics and their changes over time, and not only some vacancy rates, but also rent growth and the cap rates. And a cap rate, that's just something we think about as an interest rate if we have to value our real estate and look at that relative to another rate within fixed income. It's kind of a good comparable, but really what that rate is, it says if you're an office building and you're collecting $100 of rent a year, and if you're going to do that into perpetuity, what's the interest rate that basically backs into what your property is valued at today? So when property values are getting pushed up, when a lot of people are coming up and bidding property values up quite high, that's an inverse relationship. That cap rate comes down. And to us, that means it becomes less attractive relative to other asset classes. When valuations and when property values are not as high, they're lower, they're more attractive, that cap rate is higher. And so it'll look good relative to a fixed income return, a fixed income yield, other equity returns. And so we always like to see higher cap rates. So again, we can see that there's, all of these metrics, what stands out the most, it's been office, and office has certainly been the area that's been impaired the most from COVID. We are starting to see a good turnaround from that. Expectations are that folks are going to start going back into offices, maybe not to the level that they have been, but those vacancies that we've seen, and you see these vacancy rates being pretty high here relative to other segments of the market, we would expect to see that start to come down as people are going back into offices. Now, also part of that too is the segment of the market that's not coming back. Well, real estate developers are looking to convert those office buildings to other things, to apartment buildings and other areas and retail space that there might be more demand. So that's just another thing that we're paying attention to. Certainly from the standpoint of deals that your managers are looking at and are paying attention to, we want to continue to make sure that that's how they're positioned and that's how they're focused, that they're avoiding these markets that aren't going to do as well, that we have good diversification. The chart down below, again, this is just takes a look at flows. And when I talk about flows, these are investors that are new and are now coming into real estate. And we break that down into different areas of the market: value added, opportunistic, and debt and core. And again, you can see the flows have been fairly strong across all of the different types. And it just tells us that we continue to want to be diversified. We want to have core because it gives us nice income, and it's the lesser of the volatile asset classes in real estate. But we also want to have things that can add some value for us in diversification. So those value added, that's new construction and things that are a little bit more focused within sectors. And also opportunistic areas. So again, we have very good representations of that in the portfolio and want to maintain that kind of diversification. But we certainly think over the next couple of cycles, we're going to continue to see good returns across the board out of those various segments. That's a mouthful, and happy to answer any questions.
Thanks, Jeff.
Okay, are there any questions before I'm going to briefly go through the flash report? I know we're over our time, but if you'll indulge me a few minutes, and we'll go into more in-depth discussion on the report at the next meeting, the quarterly meeting. Sue, are you going to bring that up, or?
Are you able to do that?
Let me pull it up on
my Adobe kind of acting up down here, but
let me.
and I guess while you're doing that, were you wanting to ask the trustees to take any action tonight?
I would say and I apologize, I just took it down. Apologize, Gwilda.
You want to bring it back up real quick?
Yep, I'm gonna bring it up, and I'll ask if everybody can see it. Okay, is everyone able to see this?
Yep.
Okay, so yeah, so this table would be our recommendation for movements. Again, the only thing that I would qualify on this table with respect to recommendations is that the dollar amounts that you see in the flows may change marginally just based on where we are with current asset values today. But really what we would pay more attention to are these policy targets. And then certainly as we fast forward a couple pages here, these policy targets and ranges. So these would be our recommendations today.
And is your recommendation to move into these, how quickly?
So again, I would say from the standpoint of these immediate restructuring items, yeah, these would certainly be over the next couple of weeks as we can get, if we can get out redemption letters that are necessary and notifications and everything else. And then the page, the priority 2 items, these would really be over the next several months as again, as we look for ongoing liquidity for benefit payments and expenses. And then my only comment.
I don't think we need a motion if we're reallocating, correct?
You're breaking up, Chris, say it again.
I think the
Hold on,
one,
let me step out.
yeah, I think the asset allocation policy, that those percentages are changing, so that would be something, if the trustees want to elect that, we would want to have a motion on that piece of it in particular.
Okay, so we would need a motion to approve the asset allocation adjustments as presented, right?
Yeah, and we could really lump it all together, you know, and
Okay.
talk about restructuring and rebalancing, which would include this target asset allocation policy. And that would cover.
Okay. I just don't want to get ahead of myself, and I'm assuming you have that written up there so somebody can make the motion. But when we get to it,
And we do it now, or we have to wait, Sue?
We can certainly do it now. I don't have a written motion.
Well, I wrote down what Chris said. The motion would be to approve asset allocations as presented by ANCO. Is that necessary? Is there anything else I need to add?
Well, I think restructuring and rebalancing, I think
Okay.
those, all three of those things.
Restructuring and rebalancing. At the front part or the back part?
And whatever
So
order you would like.
Okay, I'd like to make a motion to approve asset allocation as presented with asset allocation and restructuring and rebalancing.
is there a
Second.
second? Any
Was that-
discussion?
Was that Donna?
No, I think that was Doris.
Okay, it's Doris, okay.
Any discussion?
Just a quick question, and I didn't read any of the information beforehand, but is there anywhere in this presentation where we have this proposed allocation lined up with our current allocation?
Yes, let me back up for you. And we can see that on this table here. So this will show you all the way to the left. And again, just to qualify, these are as of 2/28, so these values will have changed a bit. But this is where your current would be as of that period. And then the proposed to the right. And then these are the new policy targets. And then the dollar amounts that would change would be in the flow column.
Okay,
So
Yeah,
the,
so the shift is not that, they're minor changes, a lot of offsets. If you look at, I can't even see column. If you look at the 222 allocation and then the proposed, you'll see that it goes from 48 to 49, from 17 to 15, from 24.9
Right.
to 25.
Yes,
So they're,
the 228 percentages, is that where we are now, or is that the current policy?
No,
That's-
those are your actuals, not your policies.
Yeah, I was really asking about the current policy versus the proposed policy, and if those numbers are in here somewhere.
Yeah, I apologize, they're not. I can, we can send up a follow-up with that, with the change.
Okay, that'd be fine.
well, Jeff, can you pull up? So can you pull up our flash report would have our policy on the triangles, wouldn't it? I call it the triangle sheet.
It would, and I can actually pull up the policy itself so we can see those.
Actually, I have the report ready to go up.
Yeah, the reason I asked Jeff is because if you send it as a follow-up, then we have to wait another meeting and then
Yeah,
a
okay.
board meeting.
I got you. Okay, good. Gwalda, do you want to pull that
Yeah,
up?
if you can unstop sharing, then I can share my screen.
Okay.
Okay.
And Jeff, as
So
well
Jeff-
as I'm sorry, go ahead, Chris.
Here it is.
I'm sorry, Jeff. So if you could, if when you look at our policy that Gwelda's pulling up, and you can go through and say, this is what you are and this is what we're proposing, so that verbally you can tell us, and then we can see it on here.
Okay, there's a target allocation in the middle, Jeff, you wanna?
Yeah, let me, okay.
So Gwelda, does this chart tell you that, is this target allocation what Jeff was saying with the pluses and minuses in the flow columns?
This is your target allocation
Ah.
per your current policy. We have not adjusted it here. This is what you
Okay.
currently have in place.
Okay,
And where it says current is where you are as of 3/31.
Got it. And
But
so
the target
I
is
think-
what's in your investment policy document until you approve the changes today.
Okay, and so I guess Jeff, if you could just tell us what large cap would be, where we can see current, and then we can see the target if we were on target for our current policy, and then you can tell us what your proposed allocation would be.
Okay, if you can give me 2 seconds, because I'm just trying to find a good way to.
Yeah, that sounds like a lot of matching up. I guess I
No,
don't.
and I can do it. I just need a way to see both screens, and that's kind of where. So if you give me 2 seconds, I can print what I'm looking at here, and I should be able to do that.
Do you want me to go forward and just briefly go through the performance while he's pulling that up?
Yes, please.
Okay, well, just briefly on this first page of the, to frame how to look at the portfolio or the total fund during the month of March. As you can see here in that month column, actually the domestic equity markets actually look pretty good for the month of March. With you see large cap actually doing very well, the S&P 500 with a return of 3.71, and the Russell 1000 growth of 3.92, 3.91. As you can see here, the Russell 3000, which represents both growth and value in the large and small cap, the total equity in the domestic equity markets is 3.24% return. As expected, international wasn't as strong. EFA positive, but only 0.64. And the emerging markets, as expected, you can see here with a negative 6% return. If you look at the 3-month, which would be your quarterly return, if you look down that column, 3-month and year to date, being the same, as you can see, the equity markets across the board were really a hard place to be. On a relative basis, the least negative market was the Russell 1000 value, which represents
wait a
our
minute,
value
Gwelda,
stocks.
wait
Yes.
a minute. We're getting some feedback from somebody. You all need to go on mute. Somebody needs to go on mute. Okay,
Okay, so as I was saying here, as you can see, the 3-month and year-to-date are the same for the first quarter of the year. The equity markets had a really difficult time, as expected, in the first quarter of the year, with the least negative being the Russell 1000 value. The more some think the more conservative sectors, such as energy. As expected, with interest rates rising, you see the bond markets deliver not only negative returns for the month, but also for the quarter. If you look down here, you see the rates across the board increasing. If you look at the 10-year, you see it has increased steadily since 2019. The numbers have gone up significantly. And as a result, as Jeff has explained, when interest rates go up, the actual value of the bond portfolio goes down. One of the areas that you've seen significant increases in, and you all see it at the gas pump, commodities across the board went up, with oil having the largest increase. And if you look down at the bottom of the page on a year-to-date sector returns, you can see here energy for the first quarter of the year has had a return of 38.99%, followed by utilities. Both these are value sectors. And if you look across the board, you see that the bulk of the segments in the market have gone negative. So that kind of frames what was happening in the month of March, as well as the first quarter. Jeff will be going through the asset allocation, but as you can see here, as in the last report, you see your largest overweight right now is in large cap equity. You're outside of your target range. These bars represent the range, and the line in the middle represents your target for that particular segment. So large cap equity, and it's numerically shown here below the differences. As you can see, that's the largest difference is in large cap equity. As expected with the market movements, you're underweighted in international as well as emerging markets, and slightly under in your fixed income with the reduction in the values in fixed income. And the other area, which we will have to shore up, which is not uncommon, is your alternative segment. We're constantly having to commit in order to keep up with your target. As we're trying to do tonight, the target allocations will be tweaked a bit, and Jeff will come up with those numbers in a few moments. As far as the value of the portfolio, as you can see here, the value as of the end of March was $898,818,837. This is down from the market value in February, which was at $907,380,395. So you have had some losses, which I think were expected. If you look at the numbers up top, you see the equity markets as well as fixed income markets had a very difficult March. Now, if you go into the actual return of the fund, albeit we had negative numbers, not as bad as we might have expected, but you are negative compared to your policy index at a negative 0.40 versus a 0.87 over the fiscal year to date off negative 4.72 versus negative 3.63. If you look down the page, you'll see that in general, your larger or the rolled up segments just did not perform as well as their respective market benchmarks. If you look at the total domestic equity, you see the return was 1.28 versus 3.24 for the Russell 3000. This encompasses both your large cap growth and value managers as well as your small and mid cap managers in the domestic segment. If you delve deeper into the portfolio, as expected, the Mellon index S&P 500 was in line with the index, the S&P 500. The Mellon Equity Stock Index Fund was in line. It just tracks the S&P 500. Edgar Lomax, your large cap value manager, actually just slightly under its Russell 1000 value, 2.22 versus 2.82. Positive number, but not as strong as the index. But if you look at it on a longer, over the past year, you can see that manager has added value significantly above the Russell 1000 value, and as well as in a fiscal year to date. We'll be going into more in-depth discussion at the meeting next month, the quarterly meeting, as to why their numbers look like they do. Now, if you go down to your growth managers, as you can see, neither one of them kept up with the Russell 1000 growth, with Intech returning 1.76, TCW a little more aggressive, but still not returning as well as the Russell 1000 growth at 2.32 versus 3.91. As I mentioned, managers delivering positive returns, but not as strong as their respective indices. As you go deeper and go into the small mid-cap sections, Westville actually, out of your small cap managers representing 2000, or the small cap growth, as you said, they actually outperformed the Russell 2000 significantly at a 1.06 versus a 0.46 for the Russell 2000 growth. Systematic, pretty much in line with the Russell 2000 value, delivering a negative 1.91, back up, significantly less, almost exact opposite of the Russell 2000 value, a negative 1.91 versus 1.96. DFA, micro cap, positive return, but not as strong as their blended benchmark of a 1.32%, 331%. So as a result, this is your roll up of these managers together, basically a negative 0.26 versus the Russell 2000, delivering a 1.24% positive return. International, not surprisingly, tough times for international as well as emerging. As you can see here, Fidelity's numbers for a negative 0.71 versus a positive 0.64 for the developed international market. Causeway, more of a value. Tilt, just not, didn't do well in this market, a negative 2.45 versus a positive 0.64. So your total international had a tough month of March with that negative 1.54 roll-up return versus a positive 0.64 EFA. Emerging markets, you've got DFA and Invesco. DFA actually delivered a less negative number, a negative 0.20 versus a negative 2.26. We will go into deeper discussion regarding how they're able to protect better on the downside at the next meeting. The Invesco Emerging Markets Equity, I don't know if y'all remember from the last month's discussion, Invesco Emerging Markets Equity had a pretty overweight to the Ukraine-Russia stocks, and as a result, that has hurt their numbers. As you can see here for the month of March, the return was a negative 4.93 versus a negative 2.26, which rolled up for the emerging market segment, a negative 3.02 versus 2.26 for the month of March. When we go into your emerging manager of managers or Exponents, delivered a positive return, just not as strong as the MSCI World, 1.43 versus 2.74, positive, but not quite as positive as the index. You can see the stronger performing managers here were Martin and Applied Research, and Exponents is responsible for allocating amongst his different managers. But fortunately, they did deliver a positive return, but just not as positive as the respective benchmark. Any questions on equity before we go into fixed income for the month of March? Okay. The total fixed income actually, albeit negative on a relative basis, did better than the Bloomberg Aggregate Index. If you look down into the core segment of the core portion of the total fixed income, you can see Manulife was just slightly better than the Bloomberg Aggregate Index. Ernest Partners slightly below, and Exponents, which is a more of a multi-sector whose returns can be significantly different and very uncorrelated to these other two managers, a negative 3.98, which brought the core fixed income below the Bloomberg Aggregate Index. So where you were able to, you'll see a little bit further down where you actually gained some in this area. The absolute return manager, Loomis Sayles, negative 1.41 versus 0.21 for the 3-month LIBOR plus 3%. The TIPS index, as expected, right on top of the tracking the Bloomberg US TIPS index. Neuberger, the opportunistic global fixed income manager, actually more negative, a negative 1.57 versus 0.21. But if you look at your EMD blended, Lazard actually emerging market debt delivered a positive return and against a negative benchmark of negative 0.83. So that gave a value to add it to your total fixed income. And when you go to the global total global asset allocation, the roll-up return was a negative 0.54. That's a combination of GMO, which Jeff has already talked about quite a bit during his presentation, was a more negative return, a negative 2.11 versus 0.81. PIMCO All Asset, though, actually delivered a positive return, which dampened the negative return that GMO delivered, which brought your total roll-up for this segment to a negative 0.54. When you look at your hedge fund managers, Intrust, Whitebox, and Grosvenor, the best performer was Whitebox, as you can see here, with a 2.01% return versus a benchmark of 0.48. Intrust slightly negative, negative 0.08 versus 0.58, and Grosvenor a negative 2.5 versus positive 0.58. The roll-up return for these combined together was a slightly negative and negative 0.66 for compared to the hedge fund composite index of a positive 0.58%. As you know, we don't have these returns yet. Hopefully we will have those numbers in here for your real estate managers, by report time. But that's kind of the roll up and kind of gives you an idea of what to expect when we do the actual report next month. It's not going to be as pretty as it has been in the past. But you know, it's negative, but unfortunately, this is the nature of the beast when we go through these volatile markets, and we're looking at global events too that are also hurting the portfolio. And with respect to your managers and their allocations, Ukraine, Russia, nothing has changed much because, as you know, basically the markets were frozen. And the Ukraine, Russian markets were frozen, so you haven't seen much change there. The managers aren't able to liquidate. And as you can see, also when you look at the Invesco, which had the largest, the emerging markets portfolio, had the largest percentage out of all of your managers. You can see it hurt their return significantly in the month of March. You'll also see that in their quarterly returns. Any questions before we move back over to Jeff with respect to the asset allocation recommendation? Okay, I know I went through that very, very quickly. I apologize, but so Jeff, I'm gonna slide back up to this page. Do you have a question?
I did. What did we decide about PIMCO? Did we just say, we talked about it, but we didn't want to take action on PIMCO? Is that what we decided?
Yeah, our recommendation at this point is no action, to continue to watch, because there really has been no resolution with any of that litigation at this point. So I think at this point it certainly rises to the level. Let's keep them on watch and monitor to any developments there.
And then the second question is the information Angie asked for. You said that'll be forthcoming.
I think Jeff is going to discuss that now, right?
Yeah, Gwalda, if you can give me the ability to share.
Okay, let me just stop sharing. Okay.
Yeah, because while you gave me enough time to sketch something up. So.
Okay. All right. Good.
Okay, can everybody see this?
Yes, I can. Yeah.
Okay, so if you just focus on the two columns, the target allocation and then the proposed, which I highlighted. So we can start with large cap equity, which the current target is 13. The proposed would be 19. Small and mid is no change, 9 and 9. Developed international, 14, and that would decrease to 11. Emerging market equity, it's currently 8, that would go to 4. Global equity, no change at 5%, 5%. Core fixed income would go from 8% to 10%. Now here's this is a little bit different because we're recategorizing some of these managers that were in these categories. So we see absolute fixed income goes to 5, but we're just recategorizing that as global multi-sector. So you see that's going to actually be 0. TIPS is still 3. Global multi-sector goes from 5 to 9. Emerging market debt goes from 3 to 3.
Okay.
GAA 5 to 3. Hedge funds stay the same at 5. Real estate the same at 7. Alternative, the privates, equities at 7, and then the private debt goes from 3 to 5.
Okay.
Yeah, thank you for that, Jeff.
No, not a problem. I should have put that in the original report, and I apologize.
Angie, is that what you wanted?
Yep, that's it.
Okay, dope.
So we did have that motion on the floor still.
Yes, we should have tabled that motion and we didn't. So we had a huge discussion during that motion. Do anybody else have any questions? Let me see, hold on. Jeff, can you put that, let me see.
Do you want to go
Trying
back?
to find
You want to go back to the main report?
Nope, this one, hold on, I gotta pull it up. Okay. So since we totally went out of order and I didn't pull that motion, I want to make sure that
You want to
Louis
pull the
can
motion and
no,
redo
I
the
want you
mo-
to reissue the motion because we didn't even take action on it before, but now that we have this in front of us, we can see what we're actually doing.
Okay, I got you. Say the same thing, but we now
Yeah.
have the information, or say something different.
No, same thing.
Okay. Same thing, but okay. I'd like to make a motion to approve asset allocation as presented with restoration and rebalancing of the asset allocations.
Second.
Restructuring.
I'm sorry, restruct. Okay, let me start over. I'd like to make a motion. Go ahead. Let's see. I'd like to make a motion to approve asset allocation as presented with restoration and rebalancing of the allocations.
Second.
Any further discussion?
No.
Hearing none. Sue, can I get a roll call vote?
Angela Banks,
Yes.
Christina Bennett,
Yes.
Louis Cross,
Yes.
Sheila Goodwin,
Is she still here? Is she on? Sheila, you on mute?
all right. Maybe we'll get back to her. Donna Jones,
Yes.
Bobby Richardson,
Yes.
Doris Walker.
Yes.
Okay, and Sheila, are you there?
I'm calling her now.
All right, well, we do have 6, so the motion carries even if we don't have Sheila's vote.
Sometimes I say Bueller all the time in my staff meetings and no one gets it. Do we have anything else on the agenda, Sue? And Jeff and Gwalda, thank you so much. I know it was a long meeting, but we really do appreciate the explanations and the detail that you provide. It's just a different format. We're getting used to it. And I think it helps with the educational level across all around. So thank you so much.
Yeah, thank you.
Thank you all for indulging us.
Yes, it's very informative, and thank you so much. I feel that we really have. You all should change your company's name to Allstate because we feel like we're in good. You don't think so? You're gonna keep it at Amco?
I'll bring it up with management, but I think we're going to shut down on that.
All right.
Sue, do we have anything else on the
Okay.
agenda?
There's nothing else on the agenda.
Jeff and Gwalda, do you have anything else for us?
Nope, not this meeting. Thank you so much.
Oh, we have. We appreciate everyone's time and attention. We know some of this can get long and dry and boring, and we appreciate everyone's attention and questions. And certainly, it's we believe these are some good tweaks for the system. So.
Yes, absolutely.
Thank
Okay.
you.
Aye.
Hearing none, can I get a motion to adjourn?
I'd like to make a motion that we adjourn the investment committee meeting.
Richardson, second.
All those in favor, please say aye.
Aye.
Thanks, everyone.
All right.
Motion,
Good night, everyone.
meeting is adjourned.
All right.
Have a
Thank
good
you all so
Good
much.
night, everybody.
Good night.
Good night.
Thank you, well done, Jeff.
You're welcome. Thank you.